Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an introduction and really an update from a friend and colleague, Don Durrett. Don Durrett runs goldstockdata.com, which a site I've been looking at for over a decade to research the resource sector. And he also wrote the book, How to Invest in Gold and Silver. And Don, I think a lot of people know you, but for those that don't, it's your first time on the show. I think it'd be interesting to share that you've been in the sector for decades. You really have made a name for yourself in the gold and silver stocks in particular, although you invest in other commodity stocks as well. But you're really a fan of the narrative of gold and silver for all the macroeconomic reasons. But you wrote the book on how to invest in gold and silver because when you got started, there really wasn't a good one. So maybe share the background of how you got in the sector, why you wrote the book, and a little bit about your background.
Well, I started investing in juniors in 2004, and I tried to find a book on it, and there wasn't anything. I asked Bob Chapman. I sent an email into he had a podcast, and I sent an email into him, and he said there wasn't any. I just couldn't believe it. That was the answer. He said, "Sorry, Don, there isn't any." And so I had to learn on my own. And then after I learned, I said, "Well, I'm a writer, so I'm going to write it." So I wrote the book. It's really the only book on the market that explains the three categories: exploration, mid-tiers, and producers in detail. My book is basically a textbook. I go into detail on all three categories so you understand them. And so you can get up to speed fairly quickly in my book. A lot of people absolutely love my book. They read it multiple times. And so if you own a gold, silver mining stock, you want to read my book. Let's just say that.
Well, and you want to visit your site too, Gold Stock Data. You do deep dives in all these companies. You look at what could be potential three baggers, five bagger, 10 baggers. You want to be in this for the multi baggers. So maybe also just share a brief statement about how to utilize your website.
Yeah, so my website, it I created the website because it didn't exist as well. And I designed it around the way that I invest, which, when I started doing this, most people didn't. And even to this day, people are finally catching up to me. I always focused on the future gold price, future silver price. I never invested for the next 12 months. I was always focusing out into the future because I believe that if you're going to be a speculator, that's the way you're going to get big alpha. So I always went into this, I wanted big alpha. So when I created my website, the first thing I did, I created like a top 25 list. And that the only way you could get on that list is you had to be a potential five bagger. And at that time, I used $100 silver and I think $2,500 gold. It might have been 2,000 gold back in 2012 when I created the website. And now today, I'm still using $100 silver, but I'm using $5,000 gold. And in my website, there's a futures section that shows the upside of the company. And it's based on that. It's based on $5,000 100. So it's kind of future oriented. Now the website is really it's not a stock picking website. It's called Gold Stock Data. So it's data. I'm giving you data. I want you to do your own due diligence. But what I do provide for people is leads. So I give people my favorites list, which has 83 stocks. And then the top 25 actually has 50 stocks because any stock that basically has a five bagger upside with good risk reward makes the top 25. So I'm giving people lots of lists and give a rating on all the companies, which people absolutely love. So I give upside ratings, risk reward ratings, quality ratings. So I give you an idea of if I think a company, if I like it or not, if I think it's quality. So I give you a ton of leads, like you can, and my search engine is very powerful. So if you want to find all the mid-tier producers in the world that I like, or all the mid-tier producers, boom, it'll show it to you. Or all the mid-tier producers that have an ASIC under $1,500, boom, you can see. So the search engine is very powerful.
Well, we'll definitely put links to both below so people can check out the research tools that you've developed for investors through the book and through the site. But I want to dig into the nitty gritty and something you said, maybe think of other interviews you've done or discussions we've had, Don, where you look at this as a one-time trade. You're not actively trading in and out of this market. You've had some strong comments about that, about why you shouldn't do that, because for you, there's a macro picture playing out here. So maybe tie into it the macro picture just briefly of why this is a one-time generational trade for you.
Yeah, so I went into it in 2004. It was always a one-time trade. And I've basically been accumulating stocks for 20 years for that trade. I plan to sell to the top. Now, at 2011, I didn't take any profits. I was up pretty big in a lot of stocks, but I didn't sell a single stock. And in hindsight, maybe it was a mistake because then we had a crash from 2011 to 2015. But I just didn't think that was it. I didn't think that was the trade. And so now we've had this long, long intermittent period from 2011 all the way to now. And now I think this is that trade. So over the next 2 to 3 years, I believe gold will go above 5,000. So this will be my opportunity for this trade to kind of unfold. And so I plan to sell to the top, unwind. I have 177 positions. We can talk about why I have 177. And my thought is I'm not going to take any profits until gold gets to 4,500. So because the reason why I'm looking at 4,500 is I think 4,500 is easy. I just feel very confident that we're going to get to 4,500. So there's no reason to take profits before then. So we'll get to 4,500 and I'll reassess and I'll basically decide, okay, how much do I take off the table now? Do I take any off the table? Do I take some? And then we'll just keep reassessing as we go higher, 46, 47, 48. But at 5,500, I'm expecting to be about 80% out is my expectation. And then the only 20% that are left are probably all have stop losses in them. In other words, they're going to stop themselves out. So that's the whole plan.
Well, I find it to be fascinating because personally, like I'm an active trader, I am in and out of some of these things, and I have a bigger portfolio, but not 170 plus stocks. And so let's go there. I get a lot of grief about it, Don, and I'm sure you do too. And I've heard other people that's a criticism they've had, like, why in the world would you want to follow that many stocks? You can't possibly monitor all the news on that. I mean, they're not using gold stock data, but and I'm on a show where I'm interviewing these companies, so it's a little easier for me. But in general, we hear all the time you only want to have 10 stocks or 20 stocks. There's an arbitrary number people pick as the limit. And you also hear some companies where they have 100% in one stock because they're in the management team and they're all in on one stock. You've diversified across it, but a little different in that you're not really trading in and out of these things. You're just buying them for this big trade. So talk about why that many positions where so many people would say, oh, Don, there's no way you can follow that many.
It's basically all about your personality and your strengths. The best way to do this is to have 20 to 30 positions and then trade them on a daily basis. But in order to do that, you have to have a trader's mentality. You have to wake up every single morning and be ready to trade. Also, there's a lot of tax implications when you have 20 or 30 stocks because you're going to have to sell stocks that kind of go down. Today's a perfect example. Like I was down 15% plus today because of a short seller put out a report on Aya. If you would have had 20 stocks and you had, 5%, 10% in Aya, you probably, if you're only going to do 10 or 20 or 30 stocks, you probably have stop losses in because one stock's going to hurt your overall returns. You could have got stopped out today on Aya easily if you had a 15% stop loss, and then that would create a tax event. And so for me, that just didn't match my personality. First of all, I don't want to use stop losses because for me it was a trade. It was a long-term trade. I don't know when the bond market. I didn't mention this. The reason why I got into it because I believe strongly, and now it's becoming pretty evident that the U.S. bond market. Well, the U.S. is basically going to go bankrupt. The bond market's going to fail. Now, people have been laughing at me for years for that. Now it's becoming more possible, if you will. Now, the bond market doesn't have to fail for me to win. All it has to do is become fragile. And it's starting to become fragile because once the bond market becomes fragile, at that point, US Treasuries are no longer risk-free. And once US Treasuries are not risk-free, then what is risk-free? Gold. So people will go to gold so gold is the winner in that outcome. Now people are talking about a reset, right? Well, that's where gold wins. And so that's why I got into it. But let's go back to why I have 177 positions. So I started collecting stocks and I found out very early on that I didn't want large positions. I didn't want large allocations. And I found that 1% was basically I found 1% is a large allocation for me. And so I do not take 1% positions very often. The only time I take more than 1% is in an ETF or a mutual fund. So I have six ETFs and three mutual funds, and all of them are 2% or higher. So an ETF and a mutual fund, I have no problem with those. So those are kind of like my foundation. That's how I diversify. But individual stocks, I have very few with a cost basis over 1%. Most of them, the vast majority, are around a 0.5%. And so by doing that, I take the emotion out of it. And what I like to do is I like to have an edge. And we're going to talk about that, about how I get an edge. So I have an edge. In other words, my portfolio is so well leveraged to the gold price that even though I'm only holding 5% positions, I'm going to have 30, 40, 50, 10 baggers if this market goes up because I've done a good job of stock picking. And so what I try to do is get a whole bunch of stocks, zero point 0.5 cost basis, zero point 0.6, zero point 0.7, zero point 0.8, but they have 10 bagger potential upside. And then I have a ton of leverage, but I have an edge. So, but I have zero emotion. Let me talk about this. So the people that have 20, 30 stocks, those guys have to be highly emotional around their portfolio because they have to monitor it on a daily basis. I don't have to because I don't have any emotion. I literally do not care if one of my stocks goes bankrupt. Like today, this is a crack up. I went down 18%. I swear to you, I had zero emotional reaction to that. None. Because I have so many positions that one stock is not going to hurt me at all. I've had over 20 years, I've had at least 10 stocks go bankrupt, at least 10. And every single one of those, all I've done is I just replace it. So what I've done is I've taken the emotion out of investing. And instead of having emotion, what I have is a strategy, and I'm disciplined in my strategy. Like I have a minimum entry point, and I have a pain point that I don't like to go above. And I like to make sure that I have a proper allocation in stocks that I like. So I have a disciplined strategy, and I feel like I have an edge. Whereas if you have 20, 30 stocks, the chances of you having a 50 bagger are very low. Whereas me, I have one stock right now that's going to be a 100 bagger that's going to go from less than $10,000 to $1 million. And if you only do 20 to 30 stocks, you're not going to have that kind of outcome. Because that stock, it was a kind of a nothing burger stock called Crocodile Gold that I invested like $7,000 in. It's going to end up being worth $1 million. Who would have thought some nothing burger stock would be a hundred bagger? But that's what you get when you buy a lot of stocks. And so I'm going to have 2 or 3 50 baggers, probably 10 25 baggers, and 30 10 baggers by having 177 positions.
So just by the law of averages, you're going to have some of those complete outperformers. And I remember Crocodile Gold because it was taken over by Newmarket Gold, which is
Yeah.
where I sold out of it. But then it was taken over by Kirkland Lake, and then that was taken over by Agnico Eagle. So you've done the whole circuit there. Pretty amazing the kind of journeys some of these projects can go on. But
Yeah.
somebody would push back on that, Don, and say, yeah, but if you really have high conviction that something's going to be a 20 bagger or 10 bagger, why not take a concentrated bet of 10% or 5% in that position? What would your answer be to those people?
You have to be disciplined. So I've been doing it for 20 years. And so you can't gamble. You want to keep that edge. So the way that I have my edge is to not over allocate and not gamble. So for instance, I absolutely love 1911 gold coming out of Beaver Creek. In theory, I should have 3% or more in 1911. All I have is a little over 1%. I am upping it a little bit. I've been adding a little bit to it, but I won't get to 1.5. So even though I absolutely love that, my favorite stock, and I only have a little over 1%. And that's discipline. It's basically being focused on your strategy. And so I do not over allocate stocks. And by doing that, I don't have favorites, if you will. The one thing that I try to emphasize is that you can't pick winners. I've learned this over time. You do not know which of your stocks are going to be the winners. You just don't. They surprise you. There's basically they do acquisitions. They get taken over. They do have discoveries. The way these stocks they change their whole personality over time, if you will. Here, perfect example is Coeur Mining. Coeur Mining was basically kind of a poorly managed company. I'll say that because if you look at historically, they haven't performed well. They do not perform well in bear markets. But I basically said you have to own them because of the location of their mines and the fact that during bull markets they do well. And I was telling everybody when Coors was down at $2, I said you have to own this company. You have to buy it because of those reasons. And nobody wanted to own it because historically it hasn't performed well. Well, they acquired Silvercrest, and that one acquisition changed the whole tone of the company, or changed the whole, I don't know, tone's the right word, dynamic, risk reward. But
And their
now that
balance
stock,
sheet.
yeah, on their balance sheet, and that stock went from $2 and now it's at over 15, just by one acquisition. And who would have thought that that's what I mean by you can't predict what's going to happen. First Majestic's a good example. They've been a poor performer, but I think it's a really good buy here because I think they're going to do some acquisitions. If you look at all the silver projects that are out there, there's a lot of really good ones, and all First Majestic has to do is buy one of them, and it kind of fixes their profile or their pipeline, and then suddenly it becomes a favorite again.
One could
So
argue they did that with Gatos when they picked up Gatos last year.
right, that was step one, but and right, that was step one that definitely it did fix them as a company, absolutely. But I think they could do another acquisition and get even better. That's what I mean. So it's hard to predict. Like a lot of people, they don't own First Majestic for that reason, but they don't, using my style where I'm basically just trying to pick potential winners, you don't know what direction they're going to go in. So now, I'm glad I didn't. I remember to say this. I don't believe you should have 177 stocks. I absolutely, that's not the way to do it. The reason why I have that many is because it's been 20 years. I've been collecting these things for 20 years, and I've been disciplined on how I've done it, how I buy them, and so I just keep going, going, going. Now I got to 100. I tried to stop. I couldn't. Got to 120, I tried to stop, I couldn't. Got to 150, and I couldn't stop. Now I'm pretty much done now. I'm at 177. I'm pretty much done. But one point I wanted to make is that's way too many. I think my favorites list has 83. Now, if you're a trader and every single day you want to get up and you want to trade those stocks, I think 30 is probably the best, is a good number to trade. And if you concentrate, you're going to outperform me if you do well. But you have to have a trader's mentality, which I don't have. But if you're not that, I think you need at least 50. And for me, 50 to 80, somewhere 50 to 80 is a really good number, I think. I don't think you need 100. Like my favorites list is 83. And I think 80 50 to 80 is a good number, depending on your personality, what you want, but you don't need 100.
Well, I'm glad to hear that because I got about 55. And people give me grief about it again, saying you can't follow that many. But I would point out, I've been doing it for a while too, Don, and my account is up 200% just this year, and it's outperformed the GDX and GDXJ. And I point out to people all the time, how many stocks do you think are in the GDXJ? There's about 60 to 70 stocks in there. How many stocks do you think are in the GDX? People have no problem buying those and weighting those 20, 30, 40% of their portfolio, or only buying those. But that's a basket of stocks. I'd rather build my own ETF with the quality stocks. So let's get into some of the ways that you get an edge by how you pick developers, how you pick producers. I don't think we have time in this one to go through all the checklists, but maybe give people some bullet points you look for. Let's maybe start with the producers and we'll do the developer second. So with producers, what are the things that animate you to move it on to your most liked list?
Yeah, well, this can be a really dry conversation. So I don't want to go into detail of each. I'll go down the checklist fairly quickly because it gets really dry when I start, talking about, each checklist, how you analyze each checklist point. So I'll just do it really quick.
Just
So
the highlight reel.
I'm going to do the highlights. So for the producer checklist, number one is properties. Number two is location. Number three is financing. Number four is management. Number five is valuation. Number six is balance sheet. Number seven is cost. Number eight is exploration pipeline. Number nine is share structure. And 10 is overall risk reward. So you basically look at each of these in detail And it takes a while to learn how, and you want to make sure that a company basically checks all the boxes. And that's how you value, that's how you get an edge. You get an edge by if a producer basically checks all the boxes, and then you get excited about it. And one of the big ones in the producer area is valuation. I don't want to buy a pricey stock. I want to buy a stock that has, really nice alpha. And so that's one of the important ones. And so if I can find a cheap quality producer, I'm going to buy it. So the next list is the developer checklist. And it's a little bit shorter, but it's actually kind of more important because it's a lot easier to find a quality producer that's cheap than it is to find a quality developer, because developers have higher risk and they can break your heart so often. So I'll go into a little more detail on the developers. So there's only six on it. So the first one is a strong project. And what is a strong project? First, for me, it has to have a nice mine life. It can't be a small deposit. I want at least 1.5 million ounces of gold, and I like to have three. And you want the grade. You want the grade to be economic. You don't want to be, uber low grade. And the recovery rate needs to have decent metallurgy, and then the economics, the capex, the AISC, the IRR. That all goes in a strong project. Number two is the upside. And for developers, I want at least 10 bagger alpha, because you want margin for error, because they will dilute you. So if you have a nice margin for error, if they dilute you, you're still going to get a nice return. And so, and the 10 bagger is at $5,000 gold. Number three is the location. Ideally, you want it to be in a mining district. I love it when you can find a company, a nice in Canada. Find a nice development project in a mining district. I like that. Number four is a management team, and the key there is experience. You want to see a CEO with a lot of experience, and you want to see a good board. Number five is the path to production. This is kind of the hardest one, because some of these early development projects, they just don't have a real strong path to production. For me, the path to production a lot of times is the presentation, the company presentation. You can get a really good feel. They give you a Gantt chart and they say, okay, this is what we're going to do in 25, 26, 27, 28. And they kind of line it all out. But if they have a plan, it should be obvious. And if they don't have a plan, it's obvious too. And so that one. And number six is insiders. If they don't have at least 25% insiders, then that's a red flag, because these development projects, the only ones that tend to go the distance, if you will, and get a path to get put into production are the ones that have those strong insiders. Good example is Adriatic. Adriatic Metals, they got taken out by Dundee. They didn't even they as soon as they built the mine, Dundee went and swooped in and bought it. If they would have had strong insiders, they would have said no. And so that's the one. Okay, the last checklist is the exploration checklist, and I have two rules. And it's important, I think, to follow these rules, especially in a bull market. In a bull market, you want elasticity. And elasticity, you have that with producers and developers. They're elastic to the gold price. The more the gold price goes up, the more they go up. Whereas exploration stocks are more inelastic. They don't really care about the gold silver price. All they care about is adding ounces in the ground. For instance, Snowline Gold. Snowline Gold didn't care. The investor didn't care about the gold price when Snowline Gold found that huge discovery hole. They just bought the stock, and they just kept buying it after every good drill hole. So exploration is more inelastic, and so they don't really work well in a bull market. They don't have the risk reward. But the two rules are this. Rule number one is you want to buy an exploration company early in the Lassonde curve. That means that you want to buy it when it's cheap. You don't want to buy exploration stocks that have already ran, if you will. You want to get them when they make the discovery. Rule number two is if it's not early in the Lassonde curve, then you want to make sure that the gold in the ground is very cheap and they have a lot of it. That's an optionality play. So you're looking for like 2 million ounces of gold valued at like under $20 an ounce in the ground. So it's either optionality or early in the Lassonde curve. So I'm glad we got a chance to go over the checklist. That was great, Shad.
Yeah, and I want to maybe ask you a couple follow-ups on each category. So with the producers, we'll start there. I'll have a question on developers and explorers. On the producers, we agree we have a lot of overlap in our list, but there are certain producers that are higher cost, and in a bull market, as the metals prices creep higher, what used to be a higher cost producer sees the biggest margin expansion. And there's also companies that have development projects that can change their cost profile, or they can make an acquisition. Like you say, they can always surprise you. But I'm going to give you two companies here to talk about. One of the companies we both like coming in this year was Avino Silver and Gold. And it's because they had that La Preciosa to come into the mix and they had a good cost profile. And we both have ridden that one higher. So I want to talk about why you liked it when a lot of people were snubbing their nose at it. And the other one I want to talk about is Endeavor Silver, where initially you did not like that acquisition that they made of Colpa, but then you've changed your mind on that. But they also have that Terranera project they're building. So just two silver stocks with gold in the mix, different stories, but how you looked at both of those coming into the year and then how you look at them now after they've been on big runs. So Avino and Endeavor Silver.
Yeah, you're absolutely right. So a lot of these check boxes for producers, one can offset the other one. Whereas in the developers, you need all six. It's very important to get all six. But in producers, some of them can offset. And so the thing that can offset cost is the projects and what they have in the ground, the actual valuation to the company. So the properties can add to valuation. So Avino, what people missed in Avino, and the whole industry missed it. I couldn't, it blew my mind how the industry just let Avino, and they, to this day, Avino is still cheap, still to this day. It's been, I don't know, 5, 6 bagger. It remains cheap. So when I spotted it at 40 cents, it was basically a 50 bagger. And I told everybody, I said, just, this is, the century, just buy this thing to the bottom. And the reason why is because how much gold, how much silver equivalent they had in the ground. So that offset their cost. The only thing they needed in cost was to survive. And they were going to survive. As long as they were going to survive, they were leveraged to the hilt at higher silver prices. So they were producing, I think, back a year ago, they were around 2 million ounces, and now they're about up to like a little over 2 silver equivalent. And this year, I think they're going to about 3.5, I think, something like that. So they're still a small producer. However, they're sitting on 350 million ounces of silver equivalent. Do the math, people. Their production is going to increase. And the story gets even better because the La Preciosa mine has low capex. So they're adding 1 million ounces right now as we speak. It's under construction right now. They're adding 1 million ounces for $10 million capex. That's just peanuts. Every 1 million ounces, this is what the industry misses. Every 1 million ounces of silver production is worth 400 to 800 million dollars in market cap valuation. Every 1 million ounces, I'll repeat, is worth 400 million to 800 million. Now, it depends on what your costs are. Okay, so if you have 1 million ounces of production and your costs are $50, your break even is $50, which is kind of high, right? That gives you $50 in free cash flow. If you have margins of $50 in free cash flow with high margins, you're probably going to get a 15 multiple. If you get a 10 multiple, that's $500 million in valuation. If you get a 15, it's $750 million. And if your costs are only $40, it's even higher. So that's what people missed, because if you look at all the production that Avino is going to add over the next 4 years, they're going to go all the way up to 8 to 9 to 10 million ounces in production, silver equivalent. And so every 500, so if you just do the math on it, so we're at 8, that's 400, that's $4 billion company. So that's what I mean, they're still cheap today. And the thing was crazy, it was absolutely crazy about Avino is that they're vulnerable as heck for a takeover. The 80% of their shares is retail. So if America's Gold and Silver, who I'm going to interview in 20 minutes, if they went in and they did a 35% premium hostile takeover, it would go through. You could do a hostile takeover and take out Avino tomorrow if you wanted to, because retail, they'll take that 35% premium. Okay, so the other one was Endeavor, right? Okay, so Endeavor, I was wrong about the project they picked up in Peru. So they paid $145 million for about 35 million ounces of silver. And I thought, they paid, $5 an ounce in the ground. Like, what the hell are you guys doing? I thought that, because basically I was looking at other deals that they could have done, like Avino. And I thought it was a stupid, I thought they overpaid and it wasn't, a great project. But then I met them at Beaver Creek and they showed me the free cash flow. It's generating free cash flow already at $40 silver, and it has a ton of leverage for higher silver. So they were one of the few companies that actually thought down the road. They're like, well done. This is kind of a long life mine. It's going to generate a lot. It's basically accretive. It's going to generate a lot of free cash flow for us. And I think it's generating this year around 20, 25 million ounces of free cash flow. That's a big chunk of money for what they paid. So they paid about 145. But on a free cash flow basis, they paid about seven, something like that, which wasn't uber pricey. But as the price, what the reason why I liked it in hindsight is because if the silver price goes up, their free cash flow, if it goes to 70, let's say it goes to 50 million, then they only paid a three multiple, and it probably will. So, and it's got some exploration potential. But overall, I thought it was fairly a creative deal, and so I was wrong about that, and I posted on Twitter that I was wrong.
What do you think about Terranera, their big project where they're going to basically double their production and
Oh,
half their cost?
I've been telling everybody that the cheapest, I have this list of stocks called the Mormons, and they're basically the eight prettiest silver miners. You want to marry all of them. You're not supposed to marry stocks, but you can marry these eight. And right now, of those eight stocks, Endeavor Silver is the cheapest one. So of all the quality producers right now, Endeavor is the cheapest one. The reason why Terranera is going to lower their costs dramatically, their free cash flow run rate right now at $43 silver is $350 million. So in Q4, they're going to generate $80 million or more in free cash flow. They're generating a boatload of free cash flow right now because of Terranera. And then they're already working on Pitarrilla right now. Pitarrilla is almost doubling their production. It's going to take about 3 years to get there. But when Pitarrilla is in production, this stock is it's uber cheap. The other thing that's amazing is that if you look at the free cash flow multiple of Endeavor Silver right now, it's at 6, which is crazy. I mean, you're paying it should be at 15. You're paying less than half. You're getting a 50% discount by buying Endeavor Silver right now. I spot these companies all the time because I've been doing this for 20 years. But Endeavor Silver is mispriced right now in a big way.
Well, I'm getting a kick out of this. I was here on mute, but I was chuckling as you were saying that. But also, I love that it's one of the Mormons that you can marry, and you can marry eight stocks. That's hilarious. Well, I want to get into the developers, but I know we're running out of time, so maybe we save that for the next one. And I want to get into the explorers more too. So maybe we'll do this again, Don, and we'll dig into the developers more and get more
Yeah.
granular on that checklist. But it's been great having you on the show. It's been great talking. We talk at conferences all the time. This is the first time we've done a podcast together, but it's been a blast, and we'll do it again. And for those that want to check out Don's work, definitely click on the links below. You can check him out over at Goldstock Data and his book, but also he does a lot of other podcasts. So be on the lookout for Don on YouTube. And Don, as always, looking forward to our next conversation.
Yeah. In closing, I just want to say I started listening to the Correlate Economic Report, I think when I started doing this in 2004. It's been around forever. And the one thing that's interesting about Shad, I think John Finnick introduced us. And we knew right off the bat, just a couple minute conversation that we both knew what the hell we were doing, right?
Birds of a feather.
Yeah, absolutely. We hit it off right off the bat, and yeah, we talk every time we see each other at a conference. We say hello. So yeah, it was great. Yeah, we'll do this again next time. We'll talk about some developers.
Sounds great, man. Well, as always, thanks for talking, Don. Thanks for being on the KE report, and good luck with that America's Gold and Silver call. That's another great company we can talk about some other time.
All right, we'll see you.